We are launching a new segment today called the Stock of the Week. We're going to highlight one of the week's biggest movers. Today, we're looking right there. Under Armour shares down nearly 20%, a little more than 18 now after a couple of percent gain, but 18% this week. What do you make of this? This was a stock that had a huge run-up. Now we're once again seemingly reassessing, Jim, the growth path.
Boy, I've looked at this a lot, Scott.
Especially in North America, by the way.
Yeah, well, it's got more of a North American exposure than its competitors, mainly Nike and Adidas. I've looked at this for so long, and boy, I've wanted to get into it. Look, I think what you're doing here is you're seeing a long-term bottom forming. I know 18% is a lot, and the rally it had is a lot, but I think it's a long-term bottom. And what you have to think about with Under Armour is the numbers right now are so low, particularly on the net income side, that the slightest outperformance on the top line or on margin expansion could really move the net income number and the earnings per share a lot. And that's where you can get the pop from this. It's just those are such small numbers now. And that's what you got to play for. Honestly, I think the consumer is in good shape, so they should be still be selling products. They haven't lost relevancy. The rub against them is they are more North America centric. But you know that going in.
The rub against them also is that they had these bloated inventory levels.
Yeah, from 2 years ago, though.
That were still being worked through.
Absolutely.
Not 2 years ago. I mean, we're talking
now. It's taken them a long time to work through these problems, but I think you're getting to the end of it.
Discounted selling prices. Now they say, okay, we've worked through some of the inventory issues. We're working our way back to a more full-price brand. Now the market's like, okay, show me that you can deliver on what you say.
Yeah, this is a high-growth story, and you're in an environment where high-growth momentum stocks are not being treated as they were being treated just 6 months ago. So I think that's part of the story. I look at an Under Armour, which I owned previously, and I owned it a little bit below where it is right now. So you could say, okay, well, why not step in and buy it again? Because the environment has changed. The environment is different. It's an environment that I want more of a consistent earnings grower like a Nike, and that's why I'm long Nike. So I think the overall economic and market condition is really what's challenging.
I mean, they had their investor day this week, right? On the guidance, the stock went down. Plank and the new president of the company came on with Sarah yesterday. The stock went down even more during and after that interview. So
here's how I look at it. Why would you possibly want to own this stock? It's a high-growth stock only in terms of how it's valued, not in terms of how they're growing.
True.
Because growth hasn't been there. So they put out guidance that makes this multiple absolutely ridiculous. For fiscal 19, 33 cents. Why do you want to own that? Why wouldn't you want to own Nike?
Let's be clear. Let's not be heroes here. No, I don't think anybody's recommending buying the stock, and I'm not. What I'm saying is,
why would you have even looked at your value player?
Yeah, because you know what? You look for unappreciated growth.
I don't think.
And once I see the growth, I could get more constructive. But it is, and I think this is what you were saying, Scott.
I don't think he's talking to you when he says, why would you buy the stock? He's talking to the investor who may be thinking about it.
I'm answering the question, though. I don't think you act like a hero here and pick up the stock. I don't think you do that until it proves that it can outperform on either the top line or margin expansion or both.
Okay, so I'll finish now.
Please do.
They gave 5-year guidance that's back-end loaded. The only place where I look at 5-year guidance is in biotech stocks, not retailers, because nobody knows what the economy is going to be in 5 years. Nobody knows what they're going to do. So the companies continually miss their targets. I missed the rally when it traded up higher, but I'd much rather be short this stock than be long it. Plus, as we've learned recently, the corporate culture is significantly damaged. It's been run like a frat house, and I don't want to own companies that have poor governance as that does.
This wasn't directly answered yesterday either when Sarah asked about that. I want to note that, too. So,
yeah, I think there's nothing here that attracts me.
There's a bit of a cred issue, perhaps, in the market at this point.
As there should be. So why should this company be selling at the multiple that it is? I just don't understand it. Chipotle, I get it, even though I think that's way overvalued. But they brought in a new CEO who's tremendous. Maybe that's what this company needs.
Okay.
Kevin Plank's done a phenomenal job getting it to where it is. But now maybe it's time for fresh eyes.